Good afternoon, ladies and gentlemen. I am very happy to be back here at Flame, and I wish to thank Durgesh Bhai, Nish Bhai, and the entire team at Flame for this. I think it's an honor for me because over the years, Flame has turned out to be one of the finest institutions for investment-related courses and seminars. And not surprisingly, because it was started by some of the finest investment minds in the country. And I really think it's a privilege and honor for me to be able to contribute whatever little I can to this endeavor. Now, about today's conversation with you. What do I intend to do? What is the purpose of this session? I think the purpose is twofold. Number one, for an asset allocator or for a family office investor who wants to invest money, the purpose of this session is to position this product correctly amongst the many investment products that are available, because a client of that kind has a wide variety of choices, even within equity. So where does this fit in without disturbing the overall asset allocation? That's one purpose. The other purpose is, there may be people who will be interested in following a style of this kind. There is no single best way to invest. All of us know that. There are dozens of ways in which one can successfully invest in the stock market, and this happens to be one of them. That's the only claim I'm going to make. If somebody wants to choose this style of investing, I want to talk from my experiences over the last 30 odd years. What are the features of this style of investing? What are the characteristics that I think are necessary to succeed in this style of investing? What to do, what to stay away from, and what are the benefits of following this style of investing? And finally, I want to explain with one example, live example. That's the structure of today's presentation. It is said that before we traverse a landscape, we have to understand the landscape. So let's understand what we are up against in the equity investment field in India. The data that I have is as of 30th April 2025, and the AMFI, which is the Association of Mutual Funds of India, the equity and hybrid funds totally have an assets under management of 46 lakh 51,516 crores. This does not include fixed income or money market funds or liquid funds, only equity and hybrid funds. And this has grown by 21% over the same period in 2024. Number two, there is a PMS industry also, and this has mutual fund schemes. There were 511 equity schemes, 31 balanced hybrid, aggressive hybrid schemes, 35 balanced advantage schemes, and 309 index funds and 233 ETFs in India as of 30th April 2025. In addition, there are more than 400 registered PMS providers in India with a cumulative assets under management of 37 lakh 80,000 crores. This of course includes discretionary PMS, advisory PMS and non-discretionary PMS, all put together, and there will be an overlap here because some wealth managers use the non-discretionary PMS to invest in other mutual funds. So there is some overlap involved here, but we can't separate it as of now, so I am using it as a cumulative figure. In addition, there are approximately 8,50,000 crores in AIFs in India. This is according to a website which I am quoting, CNBC TV 18 data. This is the landscape we are going to compete against or operate in. This does not include monies managed by proprietary investors, does not include monies managed by family offices on their own, does not include LIC and other insurance companies. It does not include all the FII investors who are there in India. So that's something to be kept in mind. Some hard facts when we begin a journey, some facts we would do well to remember. The market consists of thousands of smart people. Despite what many of us can believe, we are not the only smart person in the world. There are thousands of them, right? Almost all fund managers are products of some elite university. Everybody is from a top MBA institute. Everybody is a rank-holding chartered accountant. Everybody is a CFA charter holder. Everybody has Bloomberg terminals. Everybody has modern computerized databases. Everybody has access to the highest quality research that is available in the country. Therefore, it is, I think, impossible to sustainably out-analyze everybody else. Let's get our facts right. But the irony is, almost everyone believes that he or she is a superior investor. Yes or no? And in this, the catalyst for this thinking is the bull market. The bull market is a massive ego booster. Two multi-baggers we get and we begin to think that we are as good as Rakesh Jhunjhunwala. And 4 annual reports of Berkshire Hathaway we read and we are convinced that we are as good as Warren Buffett. What I am saying is true or not? Because he says the same thing in every annual report. Same thing he says. So you read 4 things, you say he has nothing else to say, so I know everything. And of course, there are these clickbaits in today's social media-led world. There are these clickbaits. This stock of Vijay Kedia is appreciated 20% today. Do you own any? Haven't you seen clickbaits like this? The fact is, there is no point in pretending to be somebody we are not. That's the first step in investing. Vijay Kedia is a great man. Rakesh Jhunjhunwala is a great man. But you and I are no Rakesh Jhunjhunwala. The sooner we acknowledge this fact, the better it is for you and me. We are who we are and let's be proud of it. But the good news is that it is not necessary for us to have superior intelligence. It is not necessary to have an IQ of 190. It is not necessary to out-analyze everybody else in order to be successful. That's the point. In all of these things, where does contrarian investing fit in? See, I firmly believe that investing is not just about studying macroeconomic trends, not just about studying industries, not just about studying companies. Equally importantly, investing is about studying ourselves. What is good for you need not be good for me and vice versa. What I am capable of, somebody else may not be capable of that, but he may be capable of something else. So, trying to replicate on the basis of somebody else's success is, in my opinion, a recipe for disaster. All that I am saying today is one way to invest. I will say this disclaimer at least 10 times in this presentation. It is one way to invest. It is not the best way, it is one way. Let's ask ourselves these 3 questions. Are we really capable of out-analyzing all the others in this industry? We saw the structure of the industry. Number 2, can we match the big institutions in terms of resources? Well, these guys have lakhs of crores under AUM. They can hire the best talent. They can hire the best databases. They can get third-party research much more easily than you and me. And are we privy to any information that the rest of the world is not? No. So the answer to all of these questions is a resounding no. It is therefore evident to me, and I want to convey that to you, that contrarian investing product cannot offer a proposition to any investor on the basis of analytical skills or superior information access. It is not possible. The only way a contrarian investment product can make sense is to build an investment strategy or investment process around the areas where a mainstream investment product would find difficult to go. Does it make sense to you? So, we can't compete head on against the big institutions. It is not possible. Let's understand mainstream investment products. And I want to make it clear that this is only an observation of a general trend. There are, of course, honorable exceptions to what I am going to say. One of the features of mainstream investment products is that they hate underperformance at any point of time. And because they hate underperformance at any point of time, they normally hesitate to buy any stock that does not show a promise of immediate upward movement within the next couple of quarters. It's an observable tendency. See, an average fund manager in a mutual fund, there are exceptions, of course. Let's say he or she buys 3 or 4 shares in the portfolio and they don't move for a few months. What happens to the NAV? The NAV is stagnant to that extent. If the NAV is stagnant, what happens to the value research ranking? It falls. If the value research ranking falls, subsequent inflows into that product is reduced. There is pressure from the sales team to improve performance. There is pressure from the CEO to improve performance. And horror of horrors, it may affect the bonus of that fund manager for that year. So these are the repercussions of lagging behind. So an average asset management company will hesitate to buy any share that does not show a promise of immediate upward movement within the next couple of quarters. Haven't you seen fund managers come on TV? Company अच्छा है लेकिन अभी कुछ trigger नहीं है. Haven't you heard this? If everybody is trigger happy, what happens is that a set of opportunities is ignored because it does not show a promise of immediate upward movement. Yes? Contrary to popular perception, contrarian investing does not mean that we go west when the rest of the world is going east. That is not what it means. Contrarian investing means waiting for interest in a particular stock or a sector to substantially subside before getting interested. So, if it's not, the intention is not to show that we are contrarian. The intention is to act strictly on economic terms. When something is ignored, it becomes cheaper. And when you buy an asset when it is cheaper, our chances of succeeding in that investment are enhanced. So, contrarian investing is just to be in sync with the first principles of investing. What is the purpose of the capital market? Capital market's purpose is to reward efficiency in the use of capital or punish inefficiency in the use of capital. That's what it's supposed to do. And one of the features of ensuring efficiency in the capital market is to pay less for what you buy. And a good asset is available at a reasonable price only when it is ignored. Disclaimer again, this is one way to invest. It is not a superior way to invest. It is a different way to invest. Before this, if I can get a portfolio that is different from the others and therefore offers diversification, at the same time gives importance to the first principles of investing, doesn't take too much risk either with the kind of companies it invests in or with the price at which it is bought, and at the same time delivers a decent alpha over a period of time, I submit it's worth it. That's the point I'm going to stress throughout in today's presentation. Now, about my favorite topic of predicting the stock market. There are three quotes I want to share with you from three different people. Prediction is very difficult, especially about the future. CFA Institute has said that strategist forecast for the S&P 500 has been off by more than 10 percentage points in 13 out of the previous 20 years. Number 5. Number 3, reason that guru is such a popular word is because charlatan is hard to spell. It's an unkind cut by William Bernstein, but I couldn't resist including this anyway. The stock market price movement is a function of literally hundreds of variables. Unfortunately, most people predict stock market prices or the entire market index price movement based on one cause and one effect. It doesn't work that way. And the confidence with which these predictions are made, my God, I'm amazed at this. I can never do it. And people substitute confidence for substance. That's what happens. It's as if they have had breakfast with Donald Trump and dinner with Jerome Powell. That's the kind of confidence they use in predicting. The realization that we cannot predict, the realization that the stock price movement is a function of hundreds of variables that are beyond our control, is the first step in contrarian investing. You've heard of this famous quote from Benjamin Graham, right? In the short term, the market is a voting machine. And in the long term, it's a weighing machine. You heard of this? I have no arguments with this quote. I think it's perfect. But it is the voting machine that causes distortions. It is the voting machines, either the excessive optimism or the excessive pessimism, that causes both distortions and opportunities for an investor. And while talking about contrarian investing, we don't have to just focus on the weighing machine, which is a metaphor for the fundamentals and the numbers. We also have to focus on the voting machine, because that is what is a collective indication of the extreme bullishness or extreme bearishness that a stock has at any point of time. That's also important. It's a narrative that completely captivates the investment world, either positively or negatively. And in all investment analysis, in so many research reports that I've read over the years, there are several important factors that are discussed. Macroeconomic factors, political factors, fundamentals of the company, technicals, all of these are discussed. But one thing that is almost never discussed is the extent of optimism that is actually built into the price, or the extent of pessimism that is actually built into the price. It's a very, very important variable to analyze. I can give you some examples. I'm not just giving you some gyan. I want to give you some real life examples. Remember this new economy boom of 99-2000? Mr. Ramdev Agarwal spoke about it in his presentation. Now, in this new economy boom, only 3 sectors participated: information technology, telecommunications, and entertainment, collectively called the new economy. Only this sector did well. Between 99 and the first quarter of 2000, they did brilliantly well at the expense of everybody else. Everybody else was derided as old economy. Yes? But let's look at the results. In March 2000, when the market was at a peak, how were the new economy stocks valued? How were the old economy stocks valued? And how did they do in the subsequent several years? Let's look at that data. Now, look at this. These were 4 or 5 of the new economy darlings of that time. GTL, Infosys, Wipro, Visualsoft Technologies and Z Entertainment. How do you conclude that there is so much optimism? Look at the relative valuation. The 5-year average P multiple for a 5-year period ending March 2000 was this. The P multiple as of 31st March 2000 was this. GTL had a 5-year average P multiple of 6.7, but as of March 2000, its P multiple was 40. Visualsoft is the most vivid example. It listed in November 1998. From November 1998 till March 2000, its P multiple average was 88.92. That was high enough. But in March 2000, its P multiple was 242. Same thing with Z Entertainment. At that time, it was called ZTV. Now it's called Z Entertainment, and also a blue chip company like Infosys. The subsequent several year return of these stocks was something like this. GTL gave minus 47% compounded for the next 5 years. Infosys gave minus 1.5% return for the next 5 years. Visualsoft gave minus 58% return for the next 5 years. And Z Entertainment gave 33% compounded return for the next 5 years. But even during this period, this mad period when the market was at a crazy peak, if one had bought disregarded shares, all this kachra old economy companies, the returns were 20% compounded for the next 7 years. Nestle, sir, was available for a market capitalization of 3,000 crores. Nobody wanted it. It was an old economy company. Larsen and Toubro, nobody wanted. But Larsen and Toubro gave 38% compounded return for the next 7 years. Popularity is risk. Volatility is not risk. Popularity is risk. One more example. Next boom happened in 2007. This time the hot sectors were not IT and entertainment, it was real estate, construction, infrastructure, power and so on and so forth. Industries like FMCG, pharma, automobiles were completely ignored. Look at this. Unitech. 5-year average P at the peak of the market, 5-year average P was 10. Unitech in 2007 December had a P multiple of 60. See, when some stock quotes at a P multiple that is 6 times its long-term average, we can reasonably conclude that there is unnecessary optimism in the stock. Fair enough? Sure enough, anybody who was brave enough to buy Unitech at that price suffered a minus 41% return for the next 5 years. Same thing with DLF, same thing with J Corp, same thing with Larsen & Toubro, which was a bad boy in 2000, became a darling in 2007. Same thing with Reliance Industries. But look at this. Look at the kind of companies that were ignored. GSK Consumer, of course, is now part of Unilever, but Unilever was ignored. It was quoting at a dividend yield of 4.5%. Nobody wanted to buy. Thank God there was no WhatsApp in those days. Otherwise, this would have suffered all the memes that ITC suffered 3 years ago. Nobody wanted to buy Lever, yeah. Why? The only reason, and this point was brought up by Prashant in his presentation yesterday, in the morning. The stock didn't move for 10 years. That's the only reason. If a stock doesn't move for a few years, it becomes a villain. Then a rising stock price becomes like Ganga Mata, all the sins are forgiven. Yes? Look at this. Hindustan Lever gave an 18% compounded return for the next 10 years. Procter & Gamble gave a 27.8% return for the next 10 years. Again, popular stocks, we lose money. Unpopular stocks, provided they are of good quality, we make decent money. Popularity is risk. If in this presentation you have just one takeaway, which I want you to take away, it is popularity equals risk. Volatility is not risk. The other side is also true. Excessive pessimism. Industrials in 2020-21. If you calculate the history of sector weights of the Nifty index, in 2020-21, industrials as a group, as a category, had 1.5% weight in the Nifty, which was a 20-year low. Nobody was willing to touch industrials in 2020-21. Public sector was another one. Prashant gave the example of State Bank of India. But today, defense is such a apple of the eye of everybody. In 2022, did anybody recommend Cochin Shipyard to you? Or Bharat Electronics? Public sector was considered untouchable. Today, everybody wants to own public sector. Private sector banks last year. HDFC Bank. Have you seen the memes around HDFC Bank? Last year. And there are several stocks even now. Why do people get carried away in a bull market? All of these are my opinions. This is not the gospel truth. These are my opinions. And I can't put it better than this quote by Charles Kindleberger. There is nothing so disturbing to one's well-being and judgment as to see a friend get rich. Most people left to themselves are happy with a 16-17% rate of return from India's stock market until they see their neighbor has made 30. That is when the problem will start. See, up to a level, competition is good. It keeps us on our toes. But beyond a point, competition gets destructive. In a raging, wild bull market, if we want to beat everybody else, it's a recipe for disaster. Let's understand this. In a bull market, if we want to be number one, what does it really mean? In a bull market, if you are number one, you are overweight on stocks and sectors that are already dangerously overvalued. Yes or no? I showed you that figure of 99-2000. Intelligent people, highly intelligent people put 90% in new economy sectors in their portfolio. Highly intelligent people. All MBAs from top schools. Why did that happen? It happened because of the desire to be number one at all points of time. There is no other reason. And then there are people who say that we can always sell it off when it begins to fall. Market gives enough signals for downturns. Participate as long as the music plays. Haven't you heard this? This is evidently told by people who believe that they can time the market to perfection. I concede that some people can time the market. Maybe 0.5% of the total investors. Let there be no illusions. All of us belong to the other 99.5. See, I am not interested in people who want to live in La La Land. I am interested in people who have a realistic estimate of themselves and their abilities. This presentation is for such people. And this is not necessarily just the instincts of the so-called retail investor. There is a tendency to condescendingly talk about the retail investors. I have known several allegedly professional investors who are prey to the same thing. They just can't tolerate if somebody else makes more money than them in any year. Now, if somebody else has made more money than us in 1 year, the following are the possibilities. Either he or she is a better investor. That is one possibility, which nobody is willing to acknowledge. Number two, maybe they have been lucky this year. Number three, maybe the stocks that they bought this year have done better. Maybe our stocks will do better next year. But no, I have to be number one at all points of time. This is the primary cause of problem. In my observation, I am saying, this Number one business is dangerous for anybody's financial health. It's not necessary to be number one. It is enough if we are consistently good. Trying to be the best is a dangerous ambition. There are other factors, of course. There is always a premium tag attached to the person or fund that has delivered the highest returns. Always a it looks good when we boast in a cocktail party that we have invested in the fund that has been ranked number one or rated 5-star or whatever. The desire to be number one, even when the valuations are dangerously high, is what makes most investors take crazy risks. I can't emphasize this point enough. Last, of course, is the fear of looking like a fool. If you buy something and doesn't move up, and your neighbor has bought something that has given 20% in 1 month, you look like a fool. But my submission, ladies and gentlemen, is that it is much better to look like a fool and act like one. And buying something at triple-digit P multiple is not my idea of intelligent behavior. Mentioned is not to re-enter another in the same industry and lose money. That's important. That's a learning. But at the same time, if I bought something at X and I sold it at 15X, what's wrong with that? Secondly, there is no need to precisely estimate the value of a stock. I firmly believe that it is better to be vaguely right than precisely wrong. A rough estimate of value is what we need. I don't think we need to precisely estimate that this is the value of a stock and therefore I should buy 50% discount to that value. Such precision is not necessary. If you do this, at the most what will happen? You may underperform for a while. That's okay, yaar. Everybody underperforms at some point of time. Have you seen any fund, any investment product that is constantly at the top? I haven't. What are the advantages of buying when a stock is unpopular? The biggest advantage is that it is cheaper when it is unpopular. In any other form of economic activity, buying an asset when it is cheaper is considered prudent. Why should it be different in the stock market? And a good company is available at a reasonable price only when it is going through under a cloud of doubt or apprehension or fear. If everybody is bullish about it, you will not get it cheap. So there will be some question marks, there will be some doubts, there will be some apprehension, some negative point about that company. You and I should come to the conclusion whether the positives outweigh the negatives. That is when it makes sense from an investment point of view. And unpopular stocks allows us to accumulate a decent quantity over a period of time. Buying a stock that quadruples or quintuples in value, if you have only 0.25% of it in your portfolio, makes no sense to me. You should have at least a decent position, and an unpopular stocks allows us to build a decent position over a period of time. Two things are very, very important in this. One is, you don't buy something simply because it is cheap. If you buy junk quality companies because it is cheap, you will end up with junk results. The quality should be not compromised. And secondly, there should be a willingness to be patient, because just because we bought it, there is no rule which says that it has to rise from the next day after we complete our purchase. There is no such rule as far as I know, neither man-made nor divine. On the contrary, it can fall even further after you begin to buy it, in which case you should be prepared to buy more of it. The focus is only this. The difficult period the company is going through, our entire research should be focused on determining whether that difficulty is a terminal difficulty or a temporary difficulty. If it's a temporary difficulty, I am very happy to buy it. If in my judgment, if it's a temporary difficulty, I am very happy to buy under such circumstances. If I think it's a terminal difficulty, I will not buy it in any case, even if it comes free. There are some things to be given up if you want to follow this style of investing. And the foremost is the desire for instant gratification. It almost never happens in this style. Some walloping is needed and to be born in this style of investing. You need to give up the focus on the when the stock will move and rather focus on why the stock should move. I can give you very good reasons as to why the stock I think should move in my portfolio. I don't have a clue about when they will move. It should be less important. If it's a good company, if it's a good balance sheet, if it's run by good quality people, and if the price is right, eventually it will do well in 7 out of 10 cases. That is all I want. 2 or 3 will go bad in any style, not just in this style. In any style it will go bad. And we have to give up the desire for constant peer or public approval. We are not going to get it. So let's get accustomed to the fact that we are not going to get peer approval or claps whenever we buy the share. We are not going to. Probably there will be jeers. They should be strong enough to withstand it. How do we know we are right? First of all, we don't. Do we know we are right? We don't. We are taking a calculated bet. We can be wrong in some times also. Secondly, we have to arm ourselves with the help of 2 companions. If investing means traversing through uncharted territory, it is better to have strong companions. And the strong companions that I am advocating are these 2. There should be confidence in the ability of the concerned company to maintain its competitive position. There should be nothing in that fundamentals of that company that gives us a doubt that the competitive position of that company is under existential threat. That's very important. The company should have the ability to grow. Even if they don't grow for the next 2 or 3 quarters, it's okay. But the ability to grow should be retained. And that we'll come to know with a diligent research process. And as I said, there should be confidence that we build up that the company's ability to compete and the difficulty the company is facing is temporary. It is not terminal. That is the focus of research. I am not interested in predicting earnings growth rate with millimetric accuracy. That is not my intention. But I should be confident of these 2 things. The company's ability to compete is intact. The company's ability to grow is intact over the next 3 to 5 years. And the difficulty it is facing, it is not a terminal difficulty. These are the things that I look for. And the valuation should be sufficiently, it should reflect the collective pessimism of the investing public. As I said, there is no perfect science behind it, but it's easy to spot an undervalued company, just as it is easy to spot an overvalued company. The difficult ones are the ones that stand on the wall. That's the most difficult companies. Thirdly, we have to remind ourselves that nobody is right all the time. Whether you follow momentum investing or you follow day trading or whether you follow growth at the right price approach or whether you follow high growth approach or you follow contrarian investing, if you get it right 7 out of 10 cases, you have a decent result. In 8 out of 10, we may get in good years. 9 out of 10, I have concluded it is not possible for me, and I don't believe 10 out of 10 is possible for anybody. Even a giant like Ramdev Agarwal said 10 out of 10 is not possible for him. So let's have a reasonable estimate of our own capabilities. Maintaining a balance between idealism and pragmatism. That's very important. See, we have taken a contrarian bet. Sometimes things don't go wrong. Sometimes things won't go the way we want it to go. What do we do at that time? Since the client's money is involved, it helps if we keep a time period until which we will stay put. And I have the same time period as what Ramdev Agarwal said in his presentation before the break. I have a waiting period of 3 years. And I also see whether the fundamentals have improved or deteriorated or stayed the same. My philosophy is, if in 3 years the stock doesn't move and if the fundamentals do not improve, in my estimate, I will sell the share. After 3 years, if the price doesn't move, but I can see that the fundamentals have improved, I will still hold the share. Both these conditions are important. Fundamentals should improve and the price doesn't move. Both are important. Number 2, we should have in place a honest self-appraisal system. The assumptions with which we buy the share, periodically we keep rechecking whether they are still valid. And the easiest person to fool in the world is ourselves. So we should be honest with ourselves whether the assumptions are still valid and to see whether there are opportunities that did not exist previously which are superior to the one that is being discussed about. In both cases, a switch in portfolio is warranted. Things that I would avoid. I'm not saying everybody should avoid this. I would avoid these things. I don't invest in any IPO. I don't invest in any highly cutting edge technology. First of all, I don't understand these things. And secondly, these are accompanied by high levels of hype. Both IPO time and cutting edge technology, there is a great deal of hype. And hype means high popularity. And high popularity means high prices. And high prices I am allergic to. And industries with very fickle demand trends. I am not interested. And let me reassure you, good money, very good money can be made with mundane, simple and boring businesses, provided the entry price is right. There is no need to go for highly cutting edge technology. It is not necessary. Or companies that have less than a very short history. I generally avoid such companies. I am not an early stage investor. I don't pretend to be. I wait for a track record to be built. What comes with the territory? The first point I've discussed already. The chosen stock can remain depressed for longer than what we desire, or conversely, it can fall after we buy it. There is no rule which says that the stock exchange bylaws don't say that the stock has to move immediately after we buy it. There is no such rule. And there is no divine. God is not interested in the stock market and your and my success. He has much better things to do. So, there will be snide comments if we buy a stock and it doesn't move for 3 years. One of the requirements of contrarian investing is the development of a fairly thick skin. If you know that you are on to a good thing, don't be bothered about snide comments. Snide comments will come, it's fine. But it's important that you level with your investors. If you're managing public money, it's important that you tell exactly what you intend to do with the investors' money and do exactly that. This I've observed over the last 20-25 years. If you say upfront that this is what I'm going to do, and you do exactly that and periodically reinforce to the client that you're indeed doing exactly that, the client is okay, by and large. They will tolerate underperformance, not indefinitely, but to a certain extent, they'll tolerate it. There will be comparisons with stocks that we don't own and that have zoomed. What you bought company X, which has given me 20% return, but company Y, which another fund manager has bought, has given 70% return. These things will come. But they will come with any fund manager, not necessarily only with contrarian investors. And there will be inevitable cases where our theory doesn't work. As I said, I am interested in being right 7 out of 10 cases. How do you handle such situations? It's always better to make it clear to the potential client about the nature of the product, what you intend to do, and then don't deviate from that. See, let's understand this. If you're managing money for an ultra high net worth client, a family office kind of client, what is it that they really want? I don't think they are interested in maximizing returns at all points of time. They have made their money, right? They have made serious money. Their intention is not to earn 1 or 2 percentage points more than everybody else. Their intention is, well, I have made my money the hard way. I don't want some smart aleck to come and destroy it. That is their primary intention. If you can show them a logical investment process that has, a good set of companies in the portfolio and a portfolio that doesn't raise their blood pressure, and at the same time give them a decent return and give a portfolio that is having a minimal overlap and therefore provides a good diversification from the mainstream investment products, they are happy. Of course, there will be a few clients who will quit and go, but that happens in any investment product. Consistency, transparency, and a logical investment process. This is far more important than 1 or 2 percentage points of return. And it is not as if this has not worked. Contrarian investing in the last 15 years, for instance, this portfolio is outperformed in 10 years and underperformed the index in 5 years. That is the track record of any good fund in this country. And the alpha that has been generated over 15 years is about between 3.5% to 4% per annum. Not world beating, but not bad either. Again, I am submitting to you. If you can get a portfolio, if a family office or a high net worth client or a wealth manager who is recommending stocks to his portfolios to his clients, gets a portfolio that is measurably different from mainstream investment products, a portfolio that does not cause high blood pressure, and a portfolio that is given a decent return over a period of time, I submit it's worth it. What is the cherry? What are the benefits? The biggest benefit is this, the point number 3. When the rest of the world veers around to our point of view, I can guarantee this. No single malt can give you a better kick. When the rest of the world agrees with our idea and the stock begins to perform after underperforming for a year or so, the resultant exhilaration is undescribable. There are, of course, other benefits. That over the years, this approach provides returns comparable to good in mainstream investment products. You don't lose out on returns. At the same time, you get a portfolio that is measurably different from mainstream investment products, therefore affording a good diversification.